Welcome to Stock Trading Ninja. My name is Frank Bunn. I am a 20-year career professional trader, and I am ranked in the top group of instructors here on Udemy. I was mentored by a Chicago Mercantile Exchange commodities trader and a retired New York options broker. I have been a trading coach since 2007. I have reached thousands of students across the globe in 129 countries. I teach probabilistic screen trading. It sounds complicated, but it's not. And the process can be simple. It is probabilistic because it's based on a theory of probability. And as you know, probability is the likeliness that an event will occur. In this case, a profitable trade. First, you learn to manage risk, risking only a small amount on each trade, with the expectation of a much larger winner. But how? This is done with recurring price patterns that result in profitable trades most of the time. You get in here and out here. Then you repeat this process over and over again, doing the exact same thing every time. This process is called sampling. Since your winners are several times larger than your losers, and you win more often than you lose, you remain profitable over time. This is called a risk game, and the result is consistency. Anyone can learn how to do this with some practice, and this practice is called screen time. All you have to do is learn the patterns and repeat the process to hone your trading skills. This is called mastering the setup, and you don't have to risk any money in order to learn how to do this. So why should you learn this skill? Are you tired of not having control over your investments? If you learn to manage your risk and take profits that are much larger than the amount you risk, you no longer have to worry so much about what the market is doing, because you will have a solid long-term plan. And this plan will give you control over your finances and your financial future. And it doesn't take as much time as you think. You can do this in your spare time. Trading is a skill with lifelong benefits, including financial independence and self-mastery. This course teaches the student how to spot low-risk continuation setups on any price chart. Basic charting and technical analysis experience is preferred. Students should have access to an analysis platform that enables scanning and has reliable, accurate data. Several platforms are supported and suggested in the course. Most importantly, the ideal student should be willing to commit to creating a simple analysis procedure and testing the system to ensure consistency prior to taking real trades. What makes this course so beneficial? You are about to learn pattern recognition-based probabilistic trading and how to achieve consistent profitability through sampling. And you'll also learn how to use technology to scan through thousands of markets to find the lowest risk, highest probability trades in just a few minutes a day. This course is different than anything else you'll find out there. Not only will you learn how to properly analyze price movement, but you will learn how to trade through the process of managing risk and consistently profiting through risk games. This is not something that is commonly taught in trading courses. Additionally, your instructor is accessible. I respond promptly to all forum posts and email inquiries. Plus, you get to join thousands of students, many of whom are making consistent gains each month using this very method. Thank you for enrolling in Stock Trading Ninja. The Ninja looks forward to hearing about your success. If you're not trading like the Ninja, you're not trading. Welcome to Stock Trading Ninja Part 2, Popular Technical Analysis Indicators. I'm your instructor, Frank Bunn. In this segment, we're going to be looking at just that, technical analysis indicators. If they work, then why isn't everyone rich? But more importantly, you're going to learn some critical information about how the action of price itself is paramount and randomly cooperates or doesn't with technical analysis indicators. And you're going to learn one seldom discussed truth about randomness that will change the way you look at trading. In this screenshot example, we see the popular Moving Average Convergence Divergence Indicator, or MACD for short, on a daily interval chart of Capital One Financial. We can see how the indicator itself oscillates around a moving average of itself. These crossovers, by conventional wisdom and according to the fine folks at Investopedia, are buy and sell signals. More on this in just a minute, but first, Let's observe an 8-month time and data series of Capital One with the indicator plotted below the price. And follow me on a little experiment. If we had traded the typical signal line crossovers we saw in the previous example, let's take a look at how well this indicator would have performed. Quite simply, using the red signal line crossover to buy and sell, we have 4 generic long trades and 3 short trades. Let's analyze this. For longs, we have 3 wins and 1 loss, and for shorts, we have 1 win and 2 losses, for a total long-short performance of 4 wins and 3 losses. Here's another widely followed indicator, the Directional Movement Index, also a crossover-based trend-following indicator, plotted on the same time and data series of Capital One Financial we saw previously. We can see how trades are conventionally triggered when the green line crosses above or below the red line, supposedly indicating a change in trend based on the indicator logic. So follow me again through the same analysis of that 8-month period on the Capital One daily interval chart, using the directional movement crossover signals this time. Let's see how it works. We have 5 long trades and 4 short trades this time, 2 more than generated by the MACD indicator. Closer analysis reveals the longs produced 3 wins and 2 losses randomly, and the short signals performed quite miserably with 1 win and 3 losses, for an overall total long-short performance of 4 wins and 5 losses. So what's going on here? Well, let's draw some random conclusions. It would appear that similar market conditions may produce radically disparate results in different indicators of the same species, in this case, trend-following indicators, and that many, in the latter case, too many false signals may be randomly generated. More importantly, we see streaks of profitable signals when the market trend cooperates, as in the first MACD example with the long trades where there were 3 wins and 1 loss as Capital One trended higher during the period. Upon even closer analysis, we see that some signals are right on time in conjunction with the price action, while other triggers are hopelessly late or behind the curve. And lastly, and most obviously, exit signals are either on time, early, or randomly absurdly late. With outcomes so random, why would anybody really bother? No wonder technical analysis gets a bad name. Well, first we have to learn the technical analysis golden rule. That is, the price action following an indicator signal is random and not determined by the indicator signal itself. Okay, this certainly makes sense. So a technical analysis signal is really nothing more than an edge, like an edge in a casino game or a card game, we hope. Just the potential greater probability of one thing happening over another. It seems to fit with what we just learned about random outcomes in the golden rule. So let's keep going. Keeping in mind that technical triggers always produce random outcomes, we now must consider the notion of trends. So here's the stock trading ninja truth of the trend. An established trend in price is statistically more likely to continue from one interval to the next than it is to reverse. And this is really interesting. So according to empirical and statistical analysis, a trend in price once begun should not finish till it's done. And this opposes the technical analysis golden rule. So when we observe the first chart of Capital One again, we can see randomly generated MACD signals within the clear long-term uptrend in Capital One. Overall, the indicator performed rather poorly, but if you had some basis for determining the trend of Capital One as up any time during that 8-month period on any given day, you would have been correct, as the price meandered higher throughout the entire interval. Fascinating, and more on this in just a minute. But it seems like we can trust the trend if we can determine it. But indicator signals themselves have a tendency to produce marginal results. Why? Well, it's a good question. Let's check it out. First, most technical analysis indicators calculate an average of recent prices, such as highs, lows, or closing prices. And any attempt to smooth market action by averaging price will randomly cause indicator output to lag current market action. In plain English, we have late signals. Okay, this makes sense. And right back to the golden rule. And third, any price action following a signal trigger is completely random, giving the empirical notion that an established trend is more likely to continue than reverse. It is really important that you understand the distinction as well as embrace the notion of randomness in short-term price movement juxtaposed to the tendency of trends to continue from one interval to the next. So how do we make this work? Well, what if indicator output will randomly lead market action? Doesn't it stand to reason that if an indicator will randomly fail, then it will also randomly be right on time? And that random technical analysis signals produce outstanding results, which we have seen in some of the examples above. And so, if market action following a signal is random, you will randomly be handed huge winners by the market, which is an empirical truth. And here is the kicker. Risk control games avail the trader to massive winners without unnecessary risk. So we're going to learn how to exploit random outcomes and use them to our best benefit with what's called a risk game. More on that in upcoming segments. But first, let's discover the truth, which is in the price action of the market itself. And so we know that indicator signals will randomly cooperate with price action. And I'm going to show you exactly how to determine which ones. But more importantly, this price action can be read and interpreted with alarming accuracy because it doesn't lag the market. So what exactly will we be doing? Well, we're going to use the indicator signal as the impulse for the trade, and we'll learn all about this when we cover the trend flow objective in the coming videos. And basically, we won't ever be trading the signal itself, but rather we'll be trading the most probable reaction within this trend flow that we're going to learn. And as you'll see, it is really easy, and it also can be spotted everywhere the price is trending. How cool is that? So we're combining the power of random technical analysis signals that are right on time with the awesome power of an established trend in price, which, as you know, is more likely to continue than it is to reverse. Sounds exciting, doesn't it? Well, it really is. And we'll get to it as soon as we learn all about the tools we'll be using. So see you in the next segment. Welcome to Stock Trading Ninja, Part 3, a primer for the uninitiated. I'm Frank Bunn, your instructor. In this segment, we're going to take a really quick look at some basic indicators, as well as their specific logic, and how we're going to exploit that logic given our newfound knowledge about randomness and trends. Next, we're going to learn about impulse and its profound importance to proper trend trading. And all of this is going to give us a firm basis for learning about the universal trigger, which exploits any technical component that crosses another with alarming accuracy. So let's get right to it, with a quick look at the MACD indicator you briefly saw in the last segment. Known by its full name, Moving Average Convergence Divergence, which is quite a mouthful, the nickname is MACD for short, which is the acronym. Okay, the MACD is a trend-following oscillator. It is the difference between two moving averages, usually 12 and 26 by default, and it also consists of a moving average of itself, which is usually 9 periods in length. These are the common parameters. So the MACD has 3 lines then. The first is the indicator itself. The second is the slow line, which is the moving average of the indicator, or also called the signal line. And the third line is the zero line, around which the MACD and the signal oscillate. Now that we have the component logic, there are 2 ways this indicator produces crossover signals. When the indicator crosses either its lagging signal line or when it crosses the zero line. Quite simply, zero line crosses are nothing more than when the base moving averages, in this case the 12 and 26, cross each other up or down, given that the MACD is nothing more than the difference between the two. So when the difference between the two is positive, or over zero, it must mean that the 12-period average is over the 26-period average. And when the difference between the two is negative, or below the zero line, then it means that the 12-period average is under or below the 26. Okay, in this example, you can thoroughly understand the logic. We have the indicator plotted below the price, and the 12 and 26 moving averages used by the indicator plotted on the price itself above. You can see when the indicator crosses the zero line that the averages are themselves crossing according to the logic. What is important to note is that the indicator will always cross the moving average of itself or the signal line before it crosses the zero line up or down. Let's move on to the directional movement indicator. This is another trend following and momentum indicator. There is a positive directional index and a negative directional index, which are derivatives of the positive or negative directional movement calculation based on whether the price itself has moved up or down in the most recent interval. So the positive DI and negative DI are the quotient of an exponential moving average, which is usually 14 periods, and the average true range in price. The actual algorithmic formula is somewhat complex and beyond the scope of this training. Besides, it would put you to sleep anyway. And so plotting the positive and negative directional indexes results in an upward momentum indicator and a downward momentum indicator. And so conventionally, when they cross, either a buy or sell signal is triggered. This is how it looks on a chart. Here you can see the specific price intervals at A and C where the positive DI crosses above the negative DI, and at point B where the positive DI crosses below the DI. Now that you understand the oscillators, let's move on and cover moving averages. Most traders, even novices, have somewhat of an understanding of moving averages, which are simply averages of a certain number of recent prices, usually closing prices. Combined, these averages are plotted and appear as a moving line on a price chart. They may be either exponential or simple in nature, whereby simple moving averages is just that, the average of the last X number of interval closes. And the exponential moving average is an algorithmically weighted average which gives more emphasis to the most recent samples in the average itself. That said, here the crossover triggers occur when either one moving average crosses another or the price itself crosses a moving average line on a chart. For our purposes in this training, we're going to only be considering exponential moving averages. Here's an example of two moving averages. You can see them crossing each other up and down on the light blue shaded areas. And here's an example of price itself interacting with a moving average. You can see price randomly crossing over and under the line. Notice how it seems to hit it quite frequently. More on this later. Okay, so we need to understand this logic because these indicators will be used to help calculate the impulse we're going to learn about in the next installment. Remember, these indicator crossovers, whatever they are not necessarily trades, and they are not setups or signals either to enter or exit the market. And also remember, the truth is in the price action itself. Everything will be clear in the coming segments. Review any material covered so far if you are uncertain about any specific concepts. And if you are ready to go, I'll catch you in the next installment where things start to get really exciting. Hi, and welcome to Stock Trading Ninja Part 4, System Logic. This is your instructor, Frank Bunn. Now, after an introduction to randomness, rules of the trend, and some indicator logic, we can be introduced to the specific strategy system logic. And in this installment, we are going to learn about the trend flow objective, which is the real contextual secret to proper trend trading. Next, we're going to learn the universal trigger. This is the secret sauce, so to speak, and will form the basis for specific trade setups. Following this, we are going to cover some key principles of price action. In all, the objective of this part of the training is to learn how to manage this crazy randomness we've been discussing. After all, we know we can't control it. Let's begin with the trend flow objective. There are three major components to the analysis. First, we have the impulse, which is the technical catalyst which determines the direction of the market we are trading. Although technical in nature, the catalyst for this impulse may be news, supply and demand imbalances, an analyst upgrade or downgrade, or any one of numerous technical considerations as well. Following this impulse, we have a reaction to it. This is denoted by the red area on the chart graphic. This area is typically some type of consolidation or congestion area where buying and selling has stagnated the price. Provided the reaction area does not change the trend, a breakout in the direction of the original impulse can be expected. This is the key to trend trading, and during the remainder of the training you are going to learn how to specifically exploit the trend flow and learn to locate the highest probability trades in any market as a result. And this is how we are going to achieve a 90% win rate. But first we need to take a closer look at what is happening here. The market oscillates between two dominant phases, expansion and contraction. When demand outstrips supply, or vice versa, the buyers will overcome the sellers, resulting in price markup, the expansion phase noted for successively higher and higher prices. The exact opposite occurs when supply outstrips demand and the sellers take control, sending prices to lower lows in the expansion down phase. After a time, in either direction, prices will hit an equilibrium whereby sellers meet the buyers and the market consolidates in a contraction phase. Contraction is characterized by range-bound, light-volume trading as price oscillates in the consolidation. Following this, some catalyst, either technical or fundamental, will cause price to enter the expansion phase once more. The cycle continues on as human fear and greed drive prices from consolidations through extreme highs and lows, cycle in and cycle out. Understanding this true nature of the markets is critical to trend trading, since uptrends and downtrends are hallmarks of expansion. Directional trading requires that prices be moving in order for the trader to profit. With this knowledge in mind, let's examine the trend flow objective again, this time with a downtrend. So we have an initial expansion phase in the market, which we now know to be impulse. Following this expansion, we enter a contraction phase, which results in the reaction to that impulse. After this, we can expect a continuation in the direction of the original impulse. Because of the market dynamics which call for continuous expansion and contraction, and because of the golden rule of trends which dictates that a trend once begun is statistically more likely to continue than it is to reverse. So now that we know all this, how do we make money? Well, the structure of the trend flow objective is going to give us a standard for entering low risk, high probability trades consistently, and here's how we are going to do it. We will look for the universal trigger, which potentially culminates in an actual trade signal, to appear within the reaction, which you know now to be the contraction phase of the trend flow. This way we are taking advantage of everything we know about randomness and trends, and also using some specific continuation patterns to establish trade entries with limited risk, and potential profit or reward, which is theoretically unlimited because the market trend in theory may continue indefinitely. And this is fantastic news because we can learn how to keep losses extremely small while allowing the market to hand us those huge and, as we know, random winners. But more on this after we learn about the secret sauce, the universal trigger. What we're going to see is that the indicator crossover triggers dictate which system we will be using. And as such, there are numerous systems available, which is what makes this strategy so diverse and scalable. We're going to also discover how this one key price pattern recurs in all systems, regardless of time interval or trigger. And finally, we have to always keep in mind that the price action trigger derives from the reaction to the system impulse within the broader trend flow objective and the overall market trend as well. So let's get to it. The swing high pattern is defined as a condition where prices rally as the system or indicator is about to flash a buy signal or a crossover. Then the interval corresponding with that signal is the highest price in the pattern. The high above becomes the swing high because the subsequent highs after the swing high are lower, and the technical trigger or the indicator signal remains in effect. This is the universal trigger. It will become more clear as you digest the logic and see plenty of examples. In this first example on a daily interval chart of Boeing Corporation, we initially determined the system to be the 6 and 18 moving averages. The 6 EMA is the blue line and the 18 EMA is the red line. Notice that at point A, the 6 crosses over the 18 exponential moving average, but that at point B, prices do not continue higher, but rather stall. Point B, being lower, makes point A the swing high pattern or the universal trigger. You may need to pause the video and return to the previous slide if you need further clarification on the logic. Do not continue until you at least understand the basic logic. The indicator cross or signal must be a breakout up interval, which in subsequent intervals creates an immediate reaction, causing the high at the indicator crossover to be the swing high. Okay, let's look at another example. In this case, we have a daily interval chart in Boeing using the directional movement indicator as the trend impulse. Here we can clearly see that the breakout up interval at point A, this price action, causes the positive DI to cross above the negative DI, triggering the technical analysis signal. But notice that immediately, price does not continue, but rather consolidates. This consolidation makes point A the swing high pattern, or the universal trigger. You should start to see the trend flow objective at work here, which is the price action that causes the indicator to trigger, and this is the uptrend impulse, followed immediately by a reaction to the signal, which is the contraction or congestion area, at which point we are going to craft a low-risk entry, positioning ourselves for expected expansion in the direction of the original impulse, which in this case is up. To get a better handle on this, let's get some more logic behind the logic. First, price momentum stalls at the signal. So we have an obvious clear indicator of the universal trigger. It is mathematically defined. Next, big money fades the widely expected trigger. Since we know outcomes to generic technical analysis signals are random, we can surmise that the knowledgeable market participants will knowingly trade against the less informed novice traders, who blindly establish entries without finesse on obvious generic indicator signals, and are consistently scalped in the process, as the market reaction to the indicator either takes out their stops or shakes out the loose hands. Several things can happen here, including stop hunting at the obvious chart support or resistance levels. However, the technical analysis signal remains in effect and the price action trend has not changed. This is the important part. The bottom line, since the trend, which as we know is more likely to continue than reverse, has not changed, uninformed market participants have been head faked, shaken out, and the price rockets into an expansion phase, which is the most probable scenario, a simple resumption of the trend in the direction of the impulse. Understanding this simple market dynamic is what makes you a professional screen trader, and the pros play it right. I'll allow this to sink in a minute. Pause the video or rewind if you have to. When you're ready, just resume. This logic is incredibly important, and unless you understand it and the magnitude of its power, the information which follows will not make sense. Okay, if you're ready to go, let's look at the inverse swing low pattern for short trades. Here, prices decline as the system or indicator is about to flash a sell signal or crossover. The interval corresponding with that signal is the lowest price in the pattern. The low above becomes the swing low because subsequent lows after the swing low are higher, and the technical trigger or indicator signal remains in effect. And this is the universal trigger for selling anything short. Let's check some examples of this. Here we have a down interval at point A, which crosses the positive DI below the negative DI in the directional movement index indicator. Note that rather than resuming at interval B, the low is higher. This higher low creates a swing low pattern at point A, and it occurs in time, allowing you to recognize it and take advantage of it. Let's check out this swing low pattern. Here we have a down impulse in the price of IBM stock. Notice that at point A, the MACD indicator crosses below its signal line. Then at point B, the downtrend stalls and a higher low evolves. This higher low makes the low at point A the swing low, or the universal trigger. And let's check out one more long example so you can really be clear on this logic prior to proceeding. Here we have an MACD signal line breakout which corresponds to a swing high pattern at point A given the lower high at point B. You should see from these examples that the universal trigger has the power to place you precisely in key contraction areas after the initial impulse that randomly result in prime, low-risk entries when the trend resumes in the direction of that initial impulse. You will see this over and over again in your own charts. Let's take a breather a minute and look at some interesting points of variation within the trend flow objective. First, there are market cycles at work, consortiums of uptrends and downtrends on various intervals, which are all at work at once as the mass of market participants decide on price minute to minute, hour to hour, and week to week. These fluctuations result in trends, countertrends, and consolidations on any interval imaginable as the market oscillates between expansion and contraction phases. Therefore, the universal trigger can and will appear in all these different contexts. What we want to do is determine the strength of the trend to achieve the objective of positioning ourselves in the universal triggers which evolve in the strongest trends. I'm going to show you exactly how to do this, but first we have to understand system entries and how to set up trades and control risk. Please do not proceed until you understand the universal trigger logic explicitly. It is imperative that you grasp all the information presented thus far before proceeding, so don't hesitate to review anything that might be unclear. And when you're ready to go, I'll catch you in the next segment. Hello, and welcome to installment number 6 of the Stock Trading Ninja training series. This is Frank Bunn, your instructor. This will really be one of the most exciting segments because we are going to learn setups, risk control, and trade management, and cover as promised exactly how to enter trades on the proper breakouts and control risk. We're also going to learn some really great management techniques as well, so you'll always know when and where to close your positions. We'll begin here by identifying system entries which evolve after the swing high-low universal trigger. The objective of this training is to establish precise, tactical trade positions. First, however, we need to cover the essential forms of risk, as we'll be using them throughout the rest of the training to establish the lowest risk, highest probability entries. The first is setup risk. This is the initial assumption of risk in terms of points or percentages, or the distance between the entry and the initial stop or exit price. The next is intrinsic risk. This is setup pattern or technical characteristics which result in either more or less technical risk or confirmation in the form of support or resistance. And lastly, we have contextual risk, where the setup pattern evolves in terms of the trend, significant highs and lows, as well as the broad market correlation. The first, setup risk, relates to the actual pattern itself, as we will see. However, forms 2 and 3 are the precise tools I use to pull massive profit out of the markets with the lowest risk entries. Because understanding intrinsic and contextual risk allows me to intuitively spot the setups where a stop out is practically impossible prior to some type of profitable follow-through in my direction. More on this in a minute, but I want you to really be clear about the different types of risk. Understanding them and learning how to exploit them will take your trading game to a whole new level. In my one-on-one coaching classes, major emphasis is placed on mastering intrinsic and contextual risk. It is just that important. Let's consider some aspects of risk as it relates to our old friend randomness. Outcomes to any technical or price action trigger are random, as we know. Recurring patterns are also random. Price action patterns will evolve randomly. The key lies in our objective. We want to exploit randomness to our best benefit. That is, we are going to learn how to intuitively select the lowest risk entries based on our understanding of market dynamics and the fundamental types of risk. But first, we need to learn how to set up these trades. So let's jump right in with the standard breakout entry procedure. Here, for longs, we place a buy stop 2 pennies above the high of the last interval bar in the swing high price action pattern. And for shorts, we place a sell stop 2 pennies or 2 cents below the low of the last interval bar in the swing low price action pattern. We can see how in the simulated chart graphic where the long and short buy stop and sell stop orders are to be placed. What we are doing in essence is using the stop breakout to anticipate the end of the reaction pattern in the trend flow objective and position ourselves at what should be the very beginning of the continuation. How are we doing this? Well, remember, in the case of the long pattern, we have established only a series of lower highs since the universal trigger. The light bulb should have popped on. Let's consider the inverse short setup. Remember, we can anticipate the end of the reaction period in the trend flow objective by sell stopping the last low in the pattern, because we have a series of uninterrupted lows since the universal trigger swing low pattern evolved. This is really a powerful tactic, and one that allowed me to properly and systematically place my entries at the most probable tactical positions. Let's see how this works. Here's an actual chart pattern in the stock of Boeing using the daily interval and the 6 and 18 exponential moving average system, which evolved a swing high pattern at the point designated. Next, we see a green bar which denotes the swing high logic. We'll cover the E-signal scripts which produce these colored bars later in the course. Then we see an interval A evolve. So what do we have here? We have a swing high evolution which establishes the impulse in the trend flow objective, followed by a 1-bar pullback and an inside interval at point A, which is one of our precise continuation patterns we learned about in the last segment. Now we want to place a buy stop 2 pennies over the high of interval A, in anticipation of a continuation of the trend in the direction of the original impulse, which in this case is up. So we're learning to use our knowledge of the continuation patterns to place appropriate buy and sell stop orders to catch the market moving in our direction. That is why trading the breakout is the standard setup entry procedure for this strategy. Well, what if it doesn't trigger? Well, we either move the stop as the pattern continues to evolve, or we cancel it because the pattern has devolved, or the trend has reversed, or we have lost the indicator signal which triggered the swing high-low pattern. Here's another example, this time a short setup in Amazon common stock. We see here a swing low pattern followed by a 1-bar pullback and an inside interval. We should begin by initially placing a sell stop at the low of the red candle, pursuant to the rules. If this isn't filled, and if the criteria for the trade still exists, meaning the trend hasn't changed, we don't have more than 2 higher highs, and the technical analysis trigger is still valid, we simply move the sell stop up to the next higher low. We do this until triggered. This is how a professional screen trader stops into the market. The trader allows the market to put him or her into the trade when prices are moving and breaking out in the same direction the trader wishes to go. Okay, so here the sell stop at the low of point A is triggered, and the pattern evolved was a pullback inside interval continuation pattern. Let's talk about this notion of walking trigger prices, because stomping into the market is how we are going to be certain to catch the breakout at the right time. First, we establish the setup according to the procedure. Then, move the buy or sell stops down for longs or up for shorts until a trade entry either triggers or becomes invalid. And remember, invalid patterns are either an adverse technical analysis signal or an excessive reaction, which is greater than 2 bars. What we want to do here is get consistent and eliminate error by only walking the trigger if we're still certain the most probable outcome is a continuation in the trend flow objective. Let's learn about establishing initial risk. We have 2 objectives here. 1, to properly assume and manage risk because we can't control it. And 2, to facilitate proper trade management strategies using risk, so we can consistently keep our losses small and allow ourselves to capture randomly huge winners. What we want to consider at this juncture is a risk-based game to take advantage of the trend. This will all be clear by the end of this video after we see how to properly analyze setup risk. Here is the Ninja risk analysis procedure. A maximum risk stop is placed 2 pennies below for a long or above for a short the trigger bar. Calculate the height of the trigger bar in points or pennies, adding 4 pennies for entry, exits, and stops. This is the maximum risk. The number in step 2 is referred to as R. Calculate the R as a percentage of the closing trigger bar price by using the following equation. We divide R by the entry price. The quotient derived in step 3 is the percent risk for the trade. We want to remember that our maximum risk stop is always the higher low of the continuation pattern, but patterns that end in an inside interval will not have a stop below or above that inside bar, but rather a maximum risk buy or sell stop 2 pennies over the high or low of the pattern, which is usually the interval which precedes the inside bar. That said, the setup risk analysis gives us everything we need to know in order to size the position and manage the trade. Some examples will help. Take this long setup in Boeing. First, notice the swing high followed by an inside interval and a 2-bar pullback. See how these patterns recur all the time? So walking down the buy stop according to the procedure you learned results in a fill on the breakout over interval A. Anticipating this prior to the entry, we would assume that once filled, the maximum risk stop would go 2 pennies below point B, making area C the initial risk amount, including 4 pennies or so for the stop slippage. Here's a short example in United Technologies. Here we see a swing low pattern by the evolution of the red bar in this system. It is a 1-bar pullback, so we establish a sell stop 2 pennies below point A, which triggers, and which allows us to anticipate a maximum risk stop 2 pennies over point B prior to even entering the order or being filled. So we can know exactly how much risk we are going to take before even considering entry. This is the power of breakout trading. Hence, area C plus 4 pennies gives us our initial risk amount. Let's look at setup risk and how we can reduce our maximum risk overall with tiny trigger bars. This is more or less obvious, but the market will randomly hand you low setup risk entries in the form of small trigger bars. And this is the first step toward intuitively selecting the lowest risk entries. Next, as we learn in coming segments about how to reduce intrinsic risk, we'll see that low setup risk plus low intrinsic risk creates the highest probability entries and will help us achieve our goal of winning 9 out of 10 trades. Now that we understand the specific setup entries and basic risk control, as well as what we can expect next in the training, let's consider the different types of trade management. First, there is technical-based analysis and targeting, which is tantamount to tape reading, and beyond the scope of this training series. But we also have risk-based targeting, which derives from our initial trade risk. The first is intuitive, the second is mechanical. I'm going to thoroughly detail the risk-based trading management in this segment. Remember that because we anticipate the breakout with the proper buy or sell stop, we can also foresee the exact amount of risk the trade will offer if triggered. So we can not only decide if we want to take the trade with such risk, but also we can predetermine our management tactic. You should be seeing the power of the system at this point. The trader is controlling all of the variables which he or she can control and letting randomness and random outcomes do their own thing. Remember, you don't have to know what will happen next in order to make money. We'll begin with the R game so we can learn how to create and use risk-based games. First, you simply calculate your risk accurately in points according to the procedure we just learned. Then you have what we call an R, or 1R. And we add multiples of R to the entry stop price to arrive at multiple R targets, as specified here, up to 5 times R targets and beyond if you wish. To be honest, the R game was really how I made most of my money trading, because it allowed me to take only 1 R in risk, which I could predetermine, but permit the market to go 4 or 5, and in some cases even 10 times R before I took profit. If you think about it, you only have to win half your trades if your profits are 3R or greater. Just do the math. But you're going to do better than that. You're going to learn how to win 9 out of 10 trades. So what we want to do is draw a horizontal price marker on our charts at the R targets. On an actual chart, it looks like this. This is the Boeing long trade we set up earlier. Here we see the R game in all of its glory. We have our 1R risk of 35 cents, which should include slippage, and the R targets are established. The cool thing is that we can do all this work ahead of time because the universal trigger and continuation patterns allow us to predetermine risk. This is the awesome power of the system. Now that we understand how to play the R game, I'm going to give you 3 management models you can use to know exactly when to sell, or cover your short if you're going in that direction. The first is the standard model. We establish a target window between the 2R and 3R targets. Following entry, maintain the initial maximum risk stop at the high or low of the trigger bar. When the trade price has surpassed the 1R target, move the exit stop from the original maximum risk level to break even. Exit the trade when the price enters the target window. Our objective is pushing the risk-reward skew in the trader's favor by 1 to 3 or greater. This is the standard system I use most of the time to consistently get big winners and keep my losses confined to 1R. Here's the system in action with the Boeing trade we've been watching. Enter at 106.96 above point A. When price hits 1R at 107.29, we move the stop to break even, exiting at the 2 to 3R target window above. The next management model is a bit more aggressive, and so it is called the aggressive trade management model. Here, we want to establish a target window between the 1R and 2R targets. Following entry, maintain the initial maximum risk stop at the high or low of the trigger bar. Optionally, when the trade price hits the 1R target, we shed, or sell or buy to cover, depending on going long or short, a predetermined number of shares or contracts, 1/3 to 1/2 of our position. We exit the trade when the price enters the target window. Our objective here is short-term trading, trading reversals, scalping, and risk control. The objective here is also all about getting the quick hit and controlling profit when the long-term trend is not going in our favor. Next, we want to consider the inverse of the last model with the strong trend management model. We want to establish a target window between 3R and 4R targets. Targets may also be placed between 4R and 5R targets. For long breakouts to all-time highs and early cycle entries, use 6 to 8R target windows. Following entry, maintain the initial maximum risk stop at the high or low of the trigger bar. Optionally, when the trade price hits the 2 to 3R target, shed, sell, or buy to cover a predetermined number of shares and contracts, either 1/3 to 1/2 of the position. Exit the trade when the price enters the target window. Our objective here is pushing the risk-reward skew in the trader's favor by 1 to 4 or greater. This is the management model I use to trade my super high momentum stock entries, and also my penny stock setups, because there can be such massive appreciation in price for these types of stocks. I really want to let the trend run. Let's take a look at an example of this strong trend model at work in a trade I recently took in Sellistry. This stock was really on a tear when it set up, so I felt comfortable with a relaxed management model. Since the stock had a very high relative strength, more on that in the video on scanning the markets, and was near 52-week highs. Here, you can see the beauty of the R game at work. I was able to sit until more than 6R had accrued, a massive percentage winner. I eventually sold by locking in 5R on an R stop. You should be realizing the power of the risk-based management here, and it all stems from the ability to see and analyze risk before you even enter the trade, thanks to the universal trigger and continuation patterns. So let's look at how we're going to learn to use our intuition to select the lowest risk, highest probability setups. First, we're going to look for low setup risk and low intrinsic risk, which we will learn about in the coming segments. And next, we want to consider the Ninja Golden Rule of risk management, which dictates that low initial setup risk means our risk-based targets are closer. That's right, if we have tiny triggers and small initial setup risk, the stock or market doesn't have to move as far in order to give us a nice handful of R in profit. We've covered a ton of crucial information in this video, and you'll definitely want to review everything before proceeding. So let's look at where we stand in terms of our evolving analytical matrix, which is growing as our knowledge base expands. First, as always, we have the trend flow objective, followed by the universal trigger and commensurate continuation price action patterns. Next, we can predetermine the evolution of system entries, which enables us to perform the requisite analysis to make the proper setups and control risk and manage the trade. We're really getting to the heart of the strategy now. As always, our objective is to win the vast majority of our trades and make our winners much, much larger than those less frequent losses. Please review all the information we've learned thus far. Be certain you have a firm grasp on the fundamentals. Your perspective should be changing as you acquire the skills of a seasoned screen trader with almost 2 decades of trading experience, because that is exactly what you're doing. We're going to take a break from all this strategic learning in the next video and instead talk all about how to properly scan the markets for trades. But stay tuned, because in video number 9 you're going to learn some key tricks about intuitively selecting the low-risk entries and get your trading game to 9 out of 10 winners. So get excited. And when you're ready to roll, I'll see you in the next installment. Welcome to installment number 5 in the Stock Trading Ninja series. I'm Frank Bunn, your instructor. Now we are getting to the really good stuff, system entries. We can begin to see how we're going to use all of the tools we've been given and lay a strong foundation for setting up trades and controlling risk in the next video. So let's jump right in. And the first thing we want to be certain of is that the universal trigger or the swing high-low pattern is the primary building block we're going to be using to determine entries, and that the specific price action which evolves after the evolution of the universal trigger is what we want to be watching to determine entries. What we're doing here is establishing a structure within the trend flow objective, which will allow us to control subjectivity and get consistent. So we're trading apples and apples, not apples and oranges. The objective here is the development of trading system mechanics, which will result in a specific procedure we can exploit over and over again to pull all kinds of profit out of the markets. Let's begin by establishing some ground rules for the specific reaction phases out of which we want to trade. In my coaching courses, I teach tape reading and how to determine price action and read trends within the broader trend flow objective framework. And that type of intensity is beyond the scope of the Stock Trading Ninja course. But I'm definitely going to cover everything you need to know to be your own Stock Trading Ninja. The key is that the price action following the swing high-low patterns must be corrective and suggest a continuation in the direction of the original impulse. We have to be cautious, however, because an excessive reaction may very well be a reversal. So our objective here is to trade the pullback, not the reversal, and develop a clear definition for continuation price patterns. We'll start with the price pullback golden rule, which states that a reaction in an expected long position should have no more than 2 lower lows in it, and that a reaction in an expected short position should have no more than 2 higher highs in it. Let's look at the simulated chart graphics below to get an idea about the rule. In example A, we see a reaction with 2 lower lows following the assumed swing high pattern at point A. Remember the green, red, and blue trend flow objective. We want to be anticipating expected continuations. However, we don't want to see more than 2 lower lows in the reaction because we don't want a trend change. Only a productive consolidation where the greatest likelihood of what will happen next is a continuation. Okay, let's look at the inverse in example B, where we can see the assumed swing low pattern at point B is followed by 2 higher highs. Remember, we don't want to see more than that, and if we do, we need to assume that we're dealing with a reversal and not a continuation. Let's look at some examples. Here we see a universal trigger at point A on a 6 and 18 moving average system crossover. Notice how at points B and C we have 2 consecutive lower lows. This is constructive. We don't want to see a greater reaction than that. And this next example, with the swing low pattern in the same 6 and 18 moving average system in Amazon. Here we only have a 1 bar reaction at point B followed by an inside interval. Again, the fact that we have only 1 or 2 reaction bars in these patterns makes them valid continuation prospects. Be certain to understand the price action golden rule prior to proceeding. And always remember, throughout the reaction evolution, the technical analysis signal in the system we are using to determine the universal trigger must remain in effect throughout the reaction pattern into the expected continuation. Again, using the previous Amazon short as an example, we can see that the 6 has clearly remained below the 18, so our sell signal remains in effect. Here's an example of a potential swing high pattern in Taser, which devolves at point B because the crossover buy signal invalidates when the indicator flashes another sell signal. We definitely want to avoid system entries in these types of evolutions. And here's an example of a 2-bar pullback after a point A swing high pattern which evolves a 3rd lower low into point B. Even though the indicator remains in effect, we do not want to trade this type of pattern because 3 or more lower lows are statistically changes in trend. With this in mind, let's learn about the key price action patterns we'll be seeing over and over again as we spot universal triggers. These key patterns are empirically sound and consistently demonstrate probable continuations in price, as opposed to reversals. To be clear, these patterns will immediately follow the universal trigger. They will be productive patterns which suggest continuations. They are frequently recurring. They may be parameters for trading systems. The patterns begin with the swing high or the swing low pattern. These patterns are reactions within the trend flow. This collection you are about to learn represents 90% of the possibilities you will see. And our objective here is first probability. We want to be placing our entry at the point in the trend flow where the most likely outcome is a continuation. And more importantly, we want to eliminate subjectivity and be able to quickly close the analytical window and take action. Some of these patterns recur so frequently and with such significant precision that they may be used as parameters for trading systems. That is, you may only wish to trade triggers which involve certain types of patterns. I've had tremendous success with this tactic. So let me detail these exact patterns now. The first is the inside interval, sometimes called an inside bar. These are intervals which involve a simultaneous lower high and higher low than the previous interval bar. So if our high, as in example A, is the universal trigger, we can see that an inside interval has evolved in this simulated chart graphic. Example B details the inverse pattern on a short signal where the lowest low is a swing low pattern. Note the trend flow objective, impulse, reaction, followed by expected continuation as denoted by the blue arrows. Here's an example of such a long pattern where the swing high interval is noted with the SH above the interval for swing high. See how the bar at point B evolved entirely inside the swing high interval. And here's an example of a short version. See how the interval at point B evolves entirely inside the swing low interval designated by the low marked with SL for swing low. And here's a pattern which evolves two consecutive inside intervals following the swing high evolution. These are a bit more uncommon. Next, let's check out 1 and 2 bar pullbacks. The key characteristic of these patterns is that you have either one lower low and one lower high for the long version of the 1 bar pullback, or two consecutive lower lows and lower highs for the 2 bar version of the long. We can see examples here at A and B on the simulated chart graphic. Simply reverse this for shorts. We want to see precisely either one higher low and one higher high for the 1 bar pullback, or two higher lows and two consecutive higher highs for the 2 bar pullback, as seen here in examples C and D on the chart graphics to the right. Let's have a look at some examples to be certain about this pattern. Here's a 1 bar pullback on a long example. Remember the definition. And here's a 1 bar pullback in a short example. Remember, the lows and highs which precede the pullback are always swing high-low universal triggers. And here we see a 2 bar pullback following a swing high trigger. Remember, we must have two specific lower lows and two lower highs to define this pattern. And here we have an example of a 2 bar pullback in a short candidate following a swing low pattern. Again, remember the specific definition of this pattern. Let's continue and learn about patterns which first evolve an inside interval, then a 1 or 2 bar pullback. This is a variation of the inside bar pattern and the pullbacks we just covered. In example A, we have a swing high followed by an inside bar followed by a 1 bar pullback. And we see the inverse of this in example C. And in example B, we see the swing high thrust bar followed by an inside interval and a 2 bar pullback. This is one of my favorite patterns to trade. You will see it over and over again and be amazed at how frequently it places you precisely at the end of the reaction period, just in time for a continuation. We also see the inverse of example B in example D, where we have a swing low universal trigger followed by an inside bar and a 2 bar pullback. Remember, keep the trend flow objective in mind here. The impulse, which culminates in the swing high pattern, followed by a reaction in the form of the patterns we're learning, in which we are going to take positions expecting a continuation of the original impulse. Let's see some examples of actual chart pattern evolutions. Here's a swing high followed by an inside bar and a 2 bar pullback. And here we have a short version of the inside bar followed by a 1 bar reaction after the swing low trigger. As you learn these patterns and begin to recognize them on your own charts, you'll be amazed at how these specific price action anomalies will appear over and over again, and you'll begin to see how probable they really are. Let's proceed, flipping the logic now and considering a pullback first, followed by an inside bar or inside interval. Here in example A, we have a swing high followed by a 1-bar pullback, then an inside bar, with the inverse short shown in example C. And in example B, we have a 2-bar pullback followed by an inside bar evolution, with the short version shown in example D. Let's see how these will look on the charts. Here we have a long version with the swing high followed by a 1-bar pullback and then a clear inside interval. And here is the inverse, short swing low universal trigger followed by a 1-bar pullback and then an inside bar. Here are some less common evolutions for your consideration. The first is an inside bar followed by a pullback of either 1 or 2 bars, and then another inside interval, as denoted in example A. And as we saw in a previous example, we have 2 consecutive inside intervals, as seen here in example B. Review these patterns as often as you need to in order to hone your pattern recognition skills. Being able to spot these patterns will allow you to build rock-solid samples of very probable trades and get consistent. So let's complete this part of the training by looking at our analytical matrix so far. First, as always, we have the trend flow objective, where we detect impulse expansion and then a reaction consolidation. Next, we perceive the swing high-low universal trigger pattern, which neatly provides the necessary impulse and expected reaction area, after which we can properly analyze the price action and then look for constructive continuation patterns in the form of those we just learned all about. This is really exciting and will help us, with the use of a few more tools you're going to learn, to spot specific low-risk entries which allow us to win 9 out of 10 trades. You should be excited at this point, and the light should really be coming on as you see the strategy unfolding in front of you. As in the last segment, these installments are crucial to being able to implement the system, so please review any material up to this point which may not be entirely clear prior to proceeding. It is really imperative that you have a firm grasp of these critical fundamentals. So when you're ready to go, I'll see you in the next segment. Hi, and welcome to Stock Trading Ninja, Part 9. This promises to be one of the most informative segments of the training, as you learn how to use your experience and intuition with the patterns to discern the lowest risk, highest probability setups, ones which are unlikely to get stopped out, and give you that high win rate we're looking for. Many stock trading gurus throw the terms low risk and high probability around, but they never really tell you how to do it. Well, in this installment, you're going to learn a bunch of ways to do exactly that. You're going to get hit with a lot of information here, but don't be concerned. Over time, you'll be able to make the system your own as you discover your preferred system criteria. And in the next video, I'll be showing you the basics of how to establish and set up systems. So welcome to Advanced Tactics and Strategies. The human brain and its intuition is such a powerful tool when it comes to trading, and these tools fall under the intrinsic risk category. What you're about to learn is the result of over 10 years of empirical analysis and trial and error on my part, finding out what functions best and what doesn't. Specifically, what we're going to be looking at are the contextual characteristics of the setup. That is, what technical aspects are present that further reduce entry error. The tools we'll be using are trends, support and resistance, and price action itself. The objective being the development of proper intuition as well as the high win rate. Let's start with support and resistance. Here, we'll be looking for the universal trigger to be testing or bouncing on either support or resistance. This can be in the form of longer-term technical levels or longer-term moving averages. In my experience, the long-term moving averages are the easiest, quickest, and best determinant of such support and resistance. The objective here is to locate really low-risk entries within the trend flow. Let's take it one step further and define exactly what we want to see. First, the reaction pattern should be either bouncing on the exponential moving averages specifically, or there should be a history of support or resistance which precedes the universal trigger. Let's take a look at an example. Here we see a short entry in WNR. Look at the price action pattern. It is a swing low and a 2-bar pullback. As this pattern evolves on your chart, you can see that both the red candle and the interval which precedes it are both clearly testing the 50 exponential moving average. This is low intrinsic risk. We'll get to which averages you want to be watching in just a minute. To be clear, proper testing requires that the candle body or range be on the proper side of the line, while just the wick or tail of the interval trades through the line. We'll see a lot more examples of this. Here's another entry in First Solar. Notice how the inside interval reaction bar is bouncing squarely on the 50, 100, and 200 moving averages. This pattern is bouncing on very firm long-term support. You should be seeing that variation here is relentless, which is why this is such a great intuitive tool. As far as support or resistance which precedes the universal trigger, observe this setup right here. We call this surfing, when a sequence of consecutive intervals tests the same moving average. In this case, the last 4 bars of the pattern are squarely bouncing on the 18 exponential moving average. For that matter, they are also hitting the 6 as well. This is an extremely low intrinsic risk setup. Remember, when it comes to intrinsic and contextual risk, you want to ask yourself, how likely is my maximum risk stop to be hit? If you see lots of testing or surfing, your first answer should be unlikely. That is your intuition handing you a low-risk trade. It's something that you have to get accustomed to. It doesn't happen overnight. Great traders can be made if they're not born that way. Let's consider moving average systems specifically. Because this is really the only way I trade the universal trigger, although it functions in indicators as well, moving averages are ideal, because the swing high-low pattern allows you to see that price is leading the average, with the short EMA crossing the long EMA and then immediately reacting. Here's a really great trick, and one that you've been seeing in my chart examples. The key is that the reaction price action pattern should test or bounce on the longest term EMA in the system. Observe this simulated chart graphic. Notice the second pullback bar is hitting both the moving averages. Also remember the bounce rule. Notice how the body of the candle is above the lines while the tail trades through them. This is a proper test. This is really the only tool you'll need. If you consistently trade these patterns, I can guarantee you'll have outstanding profit. Let's look at some examples of this. Here we have that SSYS surf pattern again. Notice interval A hits the 18 moving average in the pattern. Given that this is the 6 and 18 exponential moving average system, this is a very, very low risk entry. Here's another example in TRIP. Notice the inside interval tests not only the 18 exponential moving average, but also the 6. If it tests both the EMAs in the system, that's even better, as you can see. So this particular example demonstrates both low setup risk, given the small size of the inside interval reaction bar, and very low intrinsic risk, as demonstrated by the testing of the EMAs in the system. Frequently, these reaction patterns will coincide with other support or resistance as well. Here we can see the short setup in FSLR using the 6 and 18 exponential moving average system, where the reaction is clearly testing the 18, which obviously is the long-term exponential moving average, and it is also simultaneously hitting the 200 exponential moving average. This characteristic further reduces intrinsic risk. More on this in just a minute. Here's one last example of the EMA testing characteristic. In this long entry in ARNA, we see the swing high pattern where the 6 crosses the 18, and the subsequent test of the 18 in the 1-bar pullback reaction pattern. This is very, very low risk. The next tool we'll be considering is the evolution of 2 or more systems in the same setup. By definition, we have 2 or more systems simultaneously evolving swing high-low entry patterns with the same price action setup. Examples of this include 2 or more exponential moving average systems simultaneously, or an exponential moving average system and an indicator, such as the MACD, or a single moving average and an indicator. Let's look at some examples of this in action. In this example, we can see a 3-6-18 system signal in combination with an MACD signal line universal trigger. Technically, we also have a single 18 exponential moving average swing low pattern here. It just depends on how you analyze it. You'll learn more about the 3-6-18 system later. It is one of my favorite universal trigger setups. And here's another example of a moving average in combination with an indicator. The point here is that multiple systems evolving concurrently reduce intrinsic risk and theoretically give the impulse more significance. Let's move on to consider the next context. We're going to see that another great way to establish low-risk positions is to use an indicator for the universal trigger, then look for reaction price patterns that bounce on long-term averages. We've seen them in some of the earlier examples, but now I want to draw attention to it specifically, because it is one of the easiest ways to establish low intrinsic risk setups. The best examples of these are MACD or directional movement index triggers with 50, 100, or 200 exponential moving average support or resistance. Some examples will definitely help. Here we see the same Boeing day trade setup where the reaction bar is also bouncing off the 50-period moving average. And here's another short example in Boeing where the reaction is testing both the 50 and 100 exponential moving averages simultaneously. These types of setups inherently reduce risk and make a stop out over the high of the red reaction bar unlikely. Now we can cover some various filter methods I've used over the years to improve performance and sort trades. One trick is to use the traditional MACD indicator itself to filter potential setup candidates. You can filter swing high-low setups by those which evolve when the MACD indicator is above or below its signal line. You can filter setups by those which evolve when the MACD indicator is above or below the zero line. You may also filter setups by those which evolve when the MACD indicator is above or below both the signal line and the zero line. And finally, you can filter setups by system, swing high-low patterns with the signal line and zero line systems flashing concurrent triggers. Our objective here is to establish confirmed trends in the impulse and make the continuation more likely, but more importantly, be consistent with our trade samples. In this example, we see a long setup with the MACD line over the zero line according to the procedure. And here we see a short example where the MACD line is clearly trading below the zero line. These tools help confirm strength of trend and can allow you to get consistent by only taking setups which meet specific entry criteria, regardless of outcome. Another filter I want to give you is one of the most powerful tools I've ever used. I discovered this many years ago and now use it as the basis for my long-term trend analysis. It is a strength of trend indicator called the exponential moving average fan. By definition, the fan evolves when the 18, 50, 100, and 200 exponential moving averages are stacked in the proper sequence, up or down, and are equidistant and trading in the same direction. This is an indication of a very strong trend as it takes considerable time and price movement for all the averages to fan out properly in the same direction. It is a great analytical tool. In this simulated chart graphic, you can get an idea of the concept. But let's look at some real-world examples. Here we see that same BEAV long setup evolving at the same time as the strength of trend exponential moving average fan. This is such an easy, stress-free way to determine a strong trend, and it also gives you the necessary long-term averages to have on your charts for locating other low intrinsic risk entries using the other tools we've discussed. And here's a short example. Again, notice the sequence of the long-term averages. In this last example, we have one of the low-risk entries I traded in Apple Computer during its historic bull run. Notice the one-bar pullback and inside bar pattern which evolves at the green interval. But when you look at the larger contextual pattern of the exponential moving average fan, you get an idea about how strong the trend appears to be. This is how you read contextual risk. You look for the strongest trends in which to take entries with the swing high-low patterns. Theoretically and empirically, I have determined that the strength of trend is a risk reducer. That is, I am more likely to get powerful follow-through and large winners in these types of environments. Let's look at some other filters you can employ as well. We can use groups of long-term moving averages as tools to gauge trends. A great way to do this is to look at the 50, 100, and 200 exponential moving averages simultaneously to determine the long-term trend. So if the 50 is over the 100 and the 100 is over the 200, we can conclude that the long-term trend is up. Reverse this for shorts. We can also look for setups that trade or evolve over all of the EMAs that we watch, these being the 18, 50, 100, and 200 lines. Let's check out an example. Here we have a pullback in sidebar pullback pattern which breaks out over point A. And that breakout is also over all the short and long-term EMAs on the chart. The next thing you want to consider is how context determines the characteristics of the impulse, which is what we are actually trading. And given that impulse is the most critical component of the trend flow objective, we want to be certain we are always moving with the trend, given our expectation and the trade management model we are using. Let me demonstrate what I mean here. Let's return to that LPX short example we analyzed earlier. This is a great low-risk setup on the short term, with 2 if not 3 systems at work simultaneously. But when we observe the long-term picture, we can see the short setup is evolving within the context of the long-term uptrend as denoted by the EMA fan moving up. This tells me that intuitively the long-term exponential moving averages will likely provide support as the price falls, which is exactly what happens. As such, this is how I use context to determine my management plan. And in this case, I used the aggressive management risk game in scout mode to get a few quick R. Expecting this setup to evolve into a long-term downtrend without serious reactions and volatility is simply just hope and guesswork. You must learn how to play the odds of what is most likely to happen next, and you can do this with your newfound knowledge of setups, intrinsic and contextual risk analysis. Let's consider the ninja trend rule of thumb for setups. You want to select the long setups in the strongest uptrends with lots of support, and you want to select short setups in the strongest downtrends with lots of resistance overhead in the pattern. This is how you achieve 9 out of 10 winners and, more importantly, get consistent. On our way to the next video where we'll learn how to customize our systems, we want to assemble the toolkit of everything that we have learned thus far. First, we have a variety of systems available for use and numerous filters and methods for sorting entries as we have just learned. These range from the mechanical through the intuitive given the different types of risk. And remember, intuitive mastery is a result of empirical analysis. As you learn the strategy and begin to see and sort real-world trade samples, you'll naturally begin to integrate the principles and determine what works best for you. I can't overstate how important this is. Remember that you want to review this material thoroughly, especially the different types of systems and filters, so we can be ready for the next segment. And when you're all set, I'll see you then. Welcome to the Price Action Trends and Momentum segment of Stock Trading Ninja. How to win 9 out of 10 trades. I'm your instructor, Frank Bunn. The purpose of this segment will be to learn how to quickly and easily determine price action trends and how to analyze momentum and to use price trends and momentum to add specificity to your setups and systems. This will facilitate quick, decisive analysis and create homogeneous samples where you will be able to repeat the process over and over again with similar setups. We will begin with price action trend analysis. In order to understand this, we will have to first learn about how to define pivot points. A low pivot is a low in price where the low is less than the previous interval low, and that low is also less than the next interval low. You can see an example of a low pivot here in the chart graphic. This is a comparison of the most recent 3 lows. Here's an example of a low pivot in an actual chart. Next, we have the high pivot. A high pivot is an interval where the high is greater than the previous interval high, and also greater than the next interval high. We can see an example of a high pivot here in the chart graphic. This is a comparison of the most recent 3 highs. Here's an example of a high pivot in an actual chart. Notice the high pivot high is higher than the previous interval and also higher than the interval which succeeds it. Pivot points are confirmed when price exceeds the most recent high or low prior to the pivot evolution. We could see an example of a confirmed low pivot in the chart graphic in the middle. The pivot confirms when price exceeds the previous high. We can see an example of a confirmed high pivot in the chart graphic on the right. When price breaks lower than the low which precedes the pivot is said to be confirmed. Confirmed pivot points can be used for trade management and stop placement. Basic trend analysis for uptrends requires that we have either a series of higher high and higher low pivots or a sequence of 3 or more higher high and higher low intervals. In chart graphic A, we see a series of higher high and higher low pivots. In chart graphic B, we see a sequence of 3 or more higher high and higher low intervals. Basic trend analysis for downtrends states that we need either a series of lower high and lower low pivots or a sequence of 3 or more lower high and lower low intervals. In chart graphic A, we see a series of lower high and lower low pivots. And in the chart graphic B, we see a sequence of 3 lower high and lower low intervals. Here's an actual chart example of price action trends. Beginning on the left, we see an example of a price action downtrend with lower low and lower high pivots. On the right, we see an example of a price action uptrend with higher low and higher high pivots. You will learn how to use these price action trends to select high probability setups in just a moment. First, we will continue with momentum analysis. Deviation in primary contextual trends is relentless. Therefore, we must have a simple, easy tool to determine momentum and a way to gauge expansion areas within the primary trend. Expansion can most easily be measured by one average of price moving away from another, and is easily spotted using the MACD indicator as a favorable or unfavorable momentum tool. Let's take a look and see how this works. On the MACD indicator, oscillation around the signal line determines momentum. Therefore, the trend, either price action or contextual, is either favorable or unfavorable. Here's an example in a primary contextual uptrend. Momentum is unfavorable when the MACD is below the signal line, and momentum becomes favorable when the MACD begins to trade above the signal line. Let's reverse this for downtrends. Here we see a primary contextual downtrend with favorable and unfavorable MACD environments. In the case of a downtrend, when the MACD is greater than its signal line, we have unfavorable momentum, and when the MACD oscillator is below its signal line, we have favorable momentum. There are several MACD parameters which may be used in order to sort and select trade entries. As a rule of thumb, the 12 and 26 period MACD with the 9 period EMA signal line is generally used for short-term momentum. The 18 and 50 period MACD with the 9 period EMA signal line is used to determine the intermediate term momentum. And the 50-100 period MACD with the 9 period EMA signal line is used to determine long-term momentum. To couple the swing high-low impulse pattern with momentum, ensure that momentum exists at the time the swing high-low pattern evolves. In the chart graphic on the left, we could see that the swing high pattern evolves with the MACD greater than the signal line. In the chart graphic in the middle, we see another swing high pattern where the MACD is already greater than the signal line at the time the pattern evolves. In the short example chart graphic on the right, we see a swing low pattern evolving and the MACD less than the signal line at the time of that swing low evolution. As a method for sorting momentum, you may consider the momentum power sort. Sort setups by the first reaction, which is the swing high or low impulse plus price pattern, after the MACD crosses the signal line up or down. In the chart graphics here, we can see that the swing high and swing low reaction is the first reaction after the MACD has crossed the signal line. The trend and momentum objective is to add contextual specificity to systems, ensuring that your price action trend precedes the setup and that momentum is in effect at the swing high-low pivot. Here's an example of the trend and momentum objective on a 350 EMA system. To the left, we see that there is a specific price action uptrend which precedes the pattern into the low-risk setup. Also note that strong momentum is in effect at the swing high evolution. Here's an example of the trend and momentum objective for a short entry. To the left, we see a price action downtrend which precedes the pattern, or a series of lower low and lower high pivots, at which point we have a low-risk setup using the 618 system. Notice also at the bottom that momentum is in effect at the swing low evolution. The key to impulse pattern recognition is setting up the same structure and context over and over again. This makes scanning and analysis quick and routine, and the decision-making process easier. Couple price action trends and momentum with your setups to achieve similar structure and context in your trade samples. Experiment until you find the process that works best for you. Consistency will follow. This concludes the price action trends and momentum segment of Stock Trading Ninja, how to win 9 out of 10 trades. I'm your instructor, Frank Bunn. Welcome to the Setup Structure segment of Stock Trading Ninja. I'm your instructor, Frank Bunn. The focus of this training segment will be to build on tools learned in the Advanced Tactics and Strategies lecture, and our objective is to increase the probability of an immediate breakout, create a filter to sort the highest probability setups, reduce setup and intrinsic risk, give the trader increased confidence, avoid more breakout failures, and detail an easy visual trade management tool. Setup structure derives from 3 main areas. The first is intrinsic risk. That is, the entry pattern should be bouncing off long-term support for a long entry or resistance for shorts. Next is the price action pattern itself, with extended patterns or patterns with reversals. And the last area is pattern resistance. That is the resistance between your setup entry, which is the pullback, and the swing high or low breakout, whether it be over or under your entry price. So in order to better filter entries, we would first want to manage intrinsic risk by looking at long-term exponential moving average support or resistance that coincides with the pattern, or look at the price action pattern itself, focusing on 3 to 4 bar continuation patterns as you can see here in the chart graphic. Or third, taking a look at pattern resistance, focusing on broken price action patterns or setups with no resistance at entry. This will be the focus of this training segment. The technical tool required for this type of setup structure is the trend line, and you will need a chart program with the proper drawing tool capability, scalable charts that permit attention to detail, and a price magnet to precisely anchor trend lines at the proper places. The procedure for using trend lines requires 2 specific lines. The first is the trend line itself moving in the direction of the trend. This line connects the most recent pivot point to the pattern high or low. The next is the counter trend line, which moves against the setup pattern and connects the swing high or swing low point to the very next interval. And in order to best employ the setup structure with trend lines, we must have a lower low in the reaction pattern for long trades, and we must have a higher high in the reaction pattern for shorts. Here is a graphic which details the procedure for using trend lines. We first identify the swing high pattern as seen here, then watch the price action evolve. Once we have the next interval high, we connect the counter trend line from the high of the swing high to the high of the next interval high. Following this, we will wait for a pattern low to evolve and attach a trend line from the most recent pivot low to the expected low of the pattern as seen here. Once the counter trend line breaks, we have an entry trigger. Trades are then entered according to the Stock Trading Ninja plan. Here's an example of a long trend line setup with the counter trend line and the trend lines in place, following the swing high pattern. Here's a short example. First we see the swing low as detailed here in the chart, followed by the counter trend line and the trend lines. Remember, there are two lines. The first in the direction of the trend, this is the trend line, connecting the most recent pivot to the pattern high or low. And also the counter trend line, which moves against the setup pattern. This connects the swing high or swing low to the next interval. Remember also that we must have a lower low in the reaction pattern for longs and a higher high in the reaction patterns for shorts, as you can see here. Also take note how the green trend line guides price action after the setup breaks out. The rules for using trend lines are relatively straightforward. The counter trend must be broken at the setup. This can either be a closing break at the interval which breaks the trend line or a subsequent interval that opens having broken the trend line. We will see examples of this in just a moment. Furthermore, the trend line must contain price. That is, the open and close of subsequent intervals must be on the proper side of the trend line. Also, the trend line should guide the trade, as the trend line continues to contain future prices. This is the trade management tool. In this example, we see an evolution of a swing high MACD signal line pattern, followed by a counter trend line which connects the swing high to the next interval high as seen here. Our trend line connects the last pivot low to the pattern low as seen here, producing an entry. In this example, we see the evolution of a swing high pattern at point A. The counter trend line connects the swing high to the next interval high, and the trend line connects the last pivot low to the low in the pattern as denoted by the green bar. Notice here, however, that the counter trend line is broken at the entry bar open. This qualifies as a broken trend line pattern. In this example, we see the evolution of a swing low, the specific trend line structure with the counter trend line and the trend line, and we can also see that the counter trend line is broken at the entry bar open. Remember that you must have a precise drawing tool which magnetically attaches trend lines to the proper highs and lows. Here you can see an example with the small circles that magnetically attach the lines to price for precision. Also notice how the trend line guides the trade and contains future price action. Here's an example of how this trend line structure can reduce breakout failure. Notice that the entry interval, denoted by the white arrow, after the trigger bar at point C opens below the counter trend line and also below the trend line. Also notice that the point C breakout fails and the pattern enters an extended consolidation. Using this trend line structure, you can avoid these types of breakouts. Let's take a look at exactly how a trade can evolve from the hard right edge. First, the swing low pattern evolves at point A in this short entry on the MACD signal line system. Next, our counter trend line is drawn from the low of point A to the low of the prospective trigger bar. After this, a trend line is drawn from the most recent high to the high of the trigger bar. After this, the trader perceives an entry when the price breaks the counter trend line at the open of the next interval, and the trade is triggered short several pennies below the low of the red trigger bar. Trade confirmation is received when the breakout trades below the swing low at point A. So let's take a look at what you can do next. First, ensure you have functional chart tools. Master the trend line procedure and integrate the principles learned in the Advanced Tactics and Strategies lecture with this trend line setup structure. After this, you want to create a trade plan with maximum specificity in terms of your system and setup structure. Begin to sample trades in groups of 10 to 20 transactions and learn to win 9 out of 10 trades. And remember, do not risk capital until you have a profitable flow. Having the proper hardware and technology to trade, in addition to fast, flexible chart tools which facilitate precise tactical analysis, is integral to your trading career. This concludes the setup structure of Stock Trading Ninja. Look for more strategies and tactics to improve your edge in the near future. I'm your instructor, Frank Bunn. Hello and welcome to part 10 of the Stock Trading Ninja training series. Now we can mix all of the tools, tips, and tricks we've learned to build and create almost any type of system we want. The key here is that the system meets your style and preferences. If you're not certain what that is, you'll learn it as soon as you integrate this knowledge and begin to watch these patterns unfold on your own charts. As I've said, that empirical knowledge is the foundation of lifelong profitability. You always want to trade in harmony with your style and risk tolerance. So let's consider building your system. When the intuitive aspects of choice meet the rigid framework of the mechanical system, the trader learns selectivity. What does this mean? In all my experimentation over the years, my greatest success has come from a mixture of the intuitive and the mechanical. I have rigid systems in place which evolve the universal trigger, but I consistently use my intuition to find the lowest intrinsic and contextual risk patterns. And now you can do the exact same thing and achieve the same success. Our objective here is to make the system easy to implement, reduce the burden of analysis, eliminate subjectivity which can cause stress and wasted effort, and create a large trade sample. So let's start with some of my favorite strategies. I prefer to use moving average systems, 1 and 2 moving averages, with a preference for 2 moving average systems. Furthermore, I prefer the 3-6-18 system to trade explosive breakouts over or under the 18-period exponential moving average. From there, I consider the larger contextual risk of what the long-term trend is doing to select my trade management model. Here's just an example of a system that just uses an 18-period exponential moving average. I will use these to trade 18 breakouts into the primary trend or couple them with the 3-6 system I mentioned earlier. Let's consider some of the 2 moving average systems that you can use immediately. There is the 6 and 18 as well as the 6 and 50 system. There's an 18 and 50 system which triggers fewer trades, however they are extremely probable, especially with the bounce off the 50-period moving average in the pattern. I also have had success with the 3 and 18, as well as the 3 and 50, whereby I use the 3 as a surrogate for the price. Remember, I generally look for entry patterns that are testing the longest average going into the setup trigger. Here's an example of the 6 and 50 system at work in an AOL short I traded last year. Notice the testing of the 50 exponential moving average in the pattern. Extremely low risk. The fact that it does it twice is even better. A few days earlier in that chart, you can see an explosive 3-6-18 system breakout short in AOL. This is really one of my favorite systems. It consistently produces great winners. Again, keep in mind that you basically want to see 2 systems at work here. The price breakout over or under the 18 and evolution of a universal trigger, and the 3 and 6 EMAs evolving a universal trigger at the same time. This produced a low-risk entry and about 4R in potential profit. Given my preference for this system, here are some filters I use to sort these trades. I'll definitely use the strength of trend exponential moving average fan as always. I'll also look for double systems, so 3-6-18 breakouts that coincide with the MACD indicator, either a swing high-low pattern or using the MACD itself as a trend indicator. I'll also use the 50 exponential moving average with this setup, taking longs over that line and shorts under it. You should be getting an idea about how variable and flexible the universal trigger really is. Your trading business can be busy, and you can scale the setups and systems as you prefer, trading as many or few systems and patterns as you prefer. Here's a great way to get started. I call it the anatomy of a system, and it will help you establish systems and begin testing and trading. First, select your indicator or moving average or averages, which will generate the swing high-low patterns. Next, you want to select, or you can use them all, the key price action patterns we learned about in video number 5. After this, you'll want to select filters for your setups from the 2 different varieties. First, context, which is the strength of trend and long-term exponential moving average trends, and second, system filters, which we discussed in Part 9, these being multiple systems, exponential moving average support and resistance, combinations, etc. Use this guide to create any system you like. The objective being consistent application. That is what you'll discover works best. In the next segment, we'll briefly look at backtesting and how to properly analyze the historical performance of any given system. Review all of the new material to this point, and when you're ready to proceed, I'll catch you in the next segment. Welcome to Part 11 of the Stock Trading Ninja series, Backtesting and Probability. I'm your instructor, Frank Bunn, and in this segment I'm going to show you how to properly backtest a system to determine probability so you can begin to get comfortable with your ninja trading skills. Let's look at our objectives here. The focus of backtesting is primarily to gauge system efficacy. Bottom line, we want to see how well it has functioned in the past had we traded signals in real time. But we also have an opportunity to test contextual variation and see how different setups performed within different long-term trend contexts. This is some good information to have, and it's how I stumbled upon the EMA Fan Strength of Trend indicator. Next, we can get an opportunity to hone our pattern recognition skills, which is always helpful. And finally, we want to remember that our goal and objective is empirical analysis and testing. We are not looking for some indication of future performance, because we can never forget the rule of randomness. So with all this in mind, let's examine the specific procedure for backtesting. First, we determine the system for universal triggers. Next, we determine the interval time frame, whether it be daily, weekly, or an intraday interval. Next, we determine and list the proper technical filters we want to use. Optionally, we can determine the specific price patterns that we learned in video number 5. Next, we determine our trade management model. After this, we calculate risk assumed on each entry plus our targets. And finally, we document wins, losses, and cumulative R using our samples. This will give you a solid foundation for objectively, and I mean objectively, analyzing historical samples. You will also be analyzing apples and apples, which is important given constantly changing contexts. Here's a recent backtest of 4 trades in Apple Computer during a 10-month period from January to October. Using the 3-6-18 system, there were 4 triggers as you can see listed, resulting in a sum total of about 100 points in profit versus a similar loss for the buy and hold investor. Let's take a look at the actual trades. Here's the first trade, a short, followed by the second, which I really didn't like as much intuitively since the 18 breakout had already occurred previously. Interestingly enough, it was the poorest performing signal. Followed by this signal, a classic breakout with the long-term trend underneath it. And finally, this last setup during the autumn correction, another classic 3-6-18 breakout. It is important to remember that I did not curve fit this data or manipulate the backtest procedure in any way. Those are the 4 consecutive trades randomly generated in that time and data series during the period specified. Use this procedure as your primary method for backtesting any system. You'll find it will give you all the information you need to objectively gauge system efficacy and begin to integrate the key principles which will make you a great mechanical intuitive trader. And I'll see you in the next installment as we begin to wrap up the training. Hi, and welcome to Stock Trading Ninja Part 7, Scanning the Markets. This is your instructor, Frank Bunn. In this installment, we're going to be covering some very important information regarding the tools I've developed to increase system efficacy and maximize your potential, and save valuable time and energy as well. First, we're going to discuss the eSignal formula scripts, otherwise known as EFS scripts for short. You've been seeing the output for these in the chart examples throughout the training so far. We'll learn about the basic trigger scripts which produce the paint bar signals and how to use them. This will be very important to eliminate much of the time and energy spent locating the universal triggers. They'll also help tremendously with setup risk analysis. I've even used EFS scripts to assist with automated trade management. These tools are vital and make the best use of state-of-the-art charting and analysis software commercially available today. and they will enable you to scan large numbers of securities very, very quickly and improve your ability to build large samples and create the turnover necessary to succeed in the trading business. The objective here primarily is to reduce analytical burden as well as increase sample size. Let's take a look at what I'm talking about here. The EFS scripts are programmed for a variety of indicator systems that involve the universal trigger, and they are more specifically programmed to generate a colored bar, either green for long or red for shorts, on the interval which immediately follows the swing high-low pattern. So in this example, we see a potential trade in dynamic materials based on the MACD zero-line crossover system. The swing high interval is noted by the familiar SH, after which the pattern forms. The script is designed to alert you immediately to the universal trigger evolution and allow maximum flexibility for the ensuing pattern to evolve as you analyze risk and decide if you wish to enter the trade, and walk down stops if necessary after a commitment is made to trade the setup. The usefulness of the scripts cannot be overstated. It puts you in the game exactly at the right time and allows for the greatest variety of random outcomes. Here is a short setup candidate using the MACD signal line system. Again, notice how the evolution of the red bar alerts you to the potential setup. Here is still another short example. So you should be starting to see that the EFS scripts are really nothing more than handy universal trigger alerts. And pattern recognition and trade selection is up to you. And that's why it works, because it isn't mechanical. It allows the trader the option of flexibility and choice. Here's yet another example in Boeing common stock. This setup randomly enabled me to take just 1% in risk on the trade. That is the type of low-risk setup you want to be targeting. This pattern evolved on the MACD signal system. More on systems and which ones to use in coming segments, but for now I just want to introduce you to the power of these charting tools. Here's a quick instruction guide on how to implement the EFS scripts after uploading them to the proper files on your trading computer. You may wish to pause the video if you want to upload the scripts now, or you may return at another time. The eSignal website also has technical support information regarding the EFS scripts should you require additional assistance. The second and equally important component of this training on scanning the market involves assembling watch lists. Watch lists are key because they not only facilitate quicker trade turnover and efficiency, but over the years I have found that different equities perform better with certain directional and market neutral strategies. And since we're concerned with direction here, we want to target momentum stocks or any market that is trending strongly. Let's begin with the quality momentum scan I rely on consistently. I use the Investors Business Daily 85/85 list almost exclusively to locate my high-quality momentum trades. This list is basically all of the stocks in the IBD database that have an earnings rank of 85 or greater and also a relative strength rank of 85 or greater. What this means is that these stocks, on a price momentum and earnings basis, are or have been outperforming 85% of all other stocks during the last 52-week period. So these are candidates with strong fundamentals and exceptional price momentum. I sort these by average daily volume and exclude stocks with less than 100,000 shares in average daily volume. According to the IBD, the 85/85 list has outperformed the S&P 500 index during the last 13 years by more than 10 to 1. So these stocks are the small and mid-cap movers you're looking for to trade momentum effectively. This is my go-to list for super high momentum stock candidates with very high relative strength rankings. More on this in a minute. StockTables.com also offers a competitive searchable database for momentum stocks as well. The next scan I do is also for momentum candidates, and it is my quality momentum scan number 2. Here I search the Investors Business Daily or the StockTables.com database for stocks with a relative strength of 90 or greater, with a price of $15 per share or greater, and which also have an average daily volume of 250,000 shares at least. Additionally, I look for stocks which have doubled in the last 52 weeks to ensure that I only have the serious movers in this watch list. Many of these stocks will triple on their way past the doubling point. This list has produced many of my largest high-priced stock gains over the years. The next scan I perform is a speculative momentum scan. Here I narrow the scan only to those stocks with a 99 relative strength, so I'm looking for those equities which are making the sharpest, quickest gains. I'll restrict this list to stocks which are less than $15 per share, but still have decent daily volume. Again, using the doubler filter, only those which have doubled in the last 52-week period assures that I'm focused on the all-out movers. It has been this list which has consistently given me my largest percentage gainers over the years. Most of my trades which have doubled and occasionally tripled in price after I entered came from this very list. I'll also focus on stocks less than $2 for my penny stock entries as well. You'll find that the universal trigger produces outstanding entries in penny stocks. Once you have the momentum list compiled, you want to focus on maintaining a list of very liquid, index-type securities for setups which randomly produce extremely low-risk setup entries like the examples we saw earlier in this video. You'll be able to routinely find lower beta stocks with setup risk of just 1% or so. And in these stocks, 3 or 4% moves are not uncommon. So you can get very large positions on in liquid stocks with decent reward-risk ratios of 3 to 1 according to standard risk-gain management models. In order to assemble these watch lists, you'll want to compile first the Dow Jones Industrial Index of 30 stocks, followed by the NASDAQ 100 Index, which are the top 100 non-financial stocks in the NASDAQ Stock Exchange, as well as the S&P 100 Index. You'll want to eliminate the duplicates when you sort them, as many of the NASDAQ stocks are also in the S&P 100 Index. This is my go-to list for moving with the market timing model, whereas these are low beta stocks typically, meaning they will usually perform about as well as the broad market in terms of volatility. These candidates are great for short positions, but I'm certain to never miss my high momentum long entries. This has been an overview of how I compile my watch lists and the tricks I've learned over the years to maximize my effort, in addition to the eSignal EFS scripts, which are now a critical part of my daily trading procedure. Take some time to ensure your watch lists are updated and ready to go. You'll miss less opportunities and your trading game will be more effective. After you've done your segment review and you're ready to move on, I'll see you in the next video. Welcome to Stock Trading Ninja Part 8, Day Trading and Forex. I'm Frank Bunn, your instructor. And before we get to the really important advanced tactics in the next segment, we're going to cover some of the best ways that I employ the strategy for short-term day trading intervals as well as the Forex markets. What we're going to see is that the universal trigger is ideal for shorter intervals, whereas it provides a ready-made, highly probable impulse that can be consistently traded and doesn't require excessive analysis. We can still achieve the high win rate we're looking for, and I've been able to routinely sample day trade intervals with 80% and 90% winners. I will show you how. We'll also run into the order entry challenge day trading presents. Risk and trade management strategies also tend to differ, primarily due to the time crunch. And we'll see in examples how the best setups evolve at specific times of the day. Our objective here is the most effective use of leverage, which for day trading is 4 to 1. We're also looking for higher turnover as well as a suitable method for hedging longer-term positions or buy and hold portfolios. So let's get started with the day trade guide. We want to focus on entries with the lowest setup risk, since the time crunch presents a serious challenge to more extensive intrinsic and contextual risk analysis. So we want to trade first and last hour reactions, as well as reactions to Federal Reserve news, which is usually around 2 p.m. on days when it is released. Included in the first hour will be 10 o'clock economic reports. The great thing about the universal trigger is that you're never trading the impulse, but always the reaction to it. So you can watch for the lowest setup risk entries. We'll also want to be using as much technology to reduce analytical burden and speed reaction time, as well as for risk calculation on the fly, position sizing, and R-game targeting. We want to be trading only listed high-volume index-type securities with very tight spreads. My day trade layout used to be about 150 stocks and 4 22-inch monitors side by side. Currently, I only use one 27-inch monitor, having created a more efficient page-based layout with more advanced changes in the newer versions of eSignal. Having recently completed a 3-year in-depth day trading research and analysis study with several traders, I have determined that the 3-minute, 5-minute, and 10-minute intervals have performed the best for this strategy historically, with some of the larger percentage winners and higher profit factor samples coming from the 10-minute interval, given that the time crunch is drastically reduced and it allows for more intrinsic and contextual risk analysis. The ideal mix for a watch list is lower beta stocks which are exhibiting high volatility and range. The strategy stop challenge is that many brokers and exchanges trigger stops based on the bid and ask prices, not the last trade. This presents a challenge given that the strategy stops into positions, so tight spreads are a must. I have also experimented with contingency orders in the form of pseudo stops, now available through many online brokers. There are additional tools available in more advanced commercial level 2 programs such as DAS or Realtick. Let's take a look at a few examples. Here we see a first hour MACD signal line system entry off the day low, and 2 signals generated on a recent first hour 5-minute interval chart of United Technologies. The MACD signal line system furnished the universal triggers you see here. Notice how the trigger evolves naturally after the impulse. In the first short, the stock was breaking to a day low. After the reversal, the second long signal caught an extremely low-risk continuation in the uptrend. Here's an example of an opening range breakout short position in Apache Corporation on a 10-minute interval. Notice the pattern, a swing low followed by an inside interval and a 1-bar pullback, a classic continuation pattern. You'll see these over and over again in the first and last hours where you can catch big institutional buy and sell programs. Let's move on and address currencies. The challenge of Forex is leverage. The pip risk on pattern intervals within the reaction phases is generally much higher. So the focus here needs to be on very low intrinsic risk, which you're going to learn all about in the next installment, Part 9. Although I have tested the strategy on intervals ranging from 4 hours to 24-hour charts, I will seldom trade anything smaller than the 24-hour chart, for a variety of reasons, including the management challenge of handling positions where intervals end and begin overnight here in the U.S. You'll want to track the major pairs, those with the tightest spreads, such as the 4 listed here. And here's my list in eSignal. Any of the singles which do not list another currency are those which cross the US dollar. You'll note also that I follow gold, and occasionally an exotic or two, here in the form of the NZD, the New Zealand dollar, because sometimes spreads tighten or very strong trends evolve, so I don't want to miss a big move. The limited numbers of pairs in Forex makes scanning quite easy. Here's a recent setup in gold, very low risk, originating from an MACD signal line trigger. And here's a Euro-US dollar setup I recently had using the same system. In this example of the Japanese yen-US dollar pair, you can see a very low risk entry using the 6 and 18 period moving average system, which is one of my favorites. Notice the green candle 4 intervals prior to the setup. You can see I was ready for an entry here, but notice the third lower low, as well as the adverse 6 and 18 crossover down which blew out the setup. Always follow the rules when it comes to excessive reactions and adverse indicator signals. Here's another entry in the yen-dollar cross, with the 618 system triggering the entry. These types of moves are not uncommon in the Forex markets, and I am able to achieve those 3 and 4-to-1 risk game targets. You'll learn that the universal trigger tends to evolve in very strong impulses. It is just the technical nature of the trigger itself. So what we want to take away from this segment is the truth of the universal trigger and the swing high-low pattern should function with similar results in any liquid charted security, the only difference being trade mechanics such as order entry and order management, as well as risk control and trade management differences found in disparate markets. In the next segment, we're going to be covering all kinds of tips and tricks to kick your game up a notch. So please review any of the basic logic and system entry material presented to this point. We're going to build on the basic strategy and explore the more intuitive aspects of intrinsic and contextual risk. So see you there. Welcome to the Creating an Effective Desktop Layout segment of Stock Trading Ninja, scanning, sorting, and selecting low-risk, high-probability setups. This segment will be an on-screen tutorial using the TC2000 platform. I'm your instructor, Frank Bunn. The goal is to create and implement a simple layout for scanning and analysis that takes approximately 10 minutes per day or week, depending on the interval you are analyzing. We also want to take advantage of the swing high-low edge, whereby the trader is alerted to potential low-risk entries before they evolve. This facilitates sorting and selection and results in consistent application. Consistent application means consistent results. The process of trading can be simple. An efficient layout reduces stress and maximizes performance. Your trading objective determines the layout style. Proper sorting allows the best setups to pop off the screen, and trading becomes effortless. The suggested layout for this training module will be the EMA systems, using the context of the exponential moving average fan. The objective is the base breakout with entries near the bottom of the consolidation. This technical context provides an excellent condition for 3 to 5R gains. Optionally, you can go short the counter trend sell-offs off the top. The chart tools for this configuration will be the 3-period exponential moving average, the 6-period exponential moving average, and the 18-period exponential moving average. Additionally, we will require the 50, 100, and 200 EMAs to configure the EMA fan. We will also need the 12-26-period MACD oscillator with the 9-period EMA signal line, and the trend line drawing tool with the Snap To feature to ensure accuracy. We will begin by configuring a simple layout in TC2000. The TC2000 Classic layout comes loaded with all kinds of information and data that is not required for consistent setup trading. Therefore, I will remove all of the tools that are not required and configure a simple layout with a daily chart, a weekly chart, and a watch list. I will begin by deleting all of the windows that I don't need. Next, I will configure this chart so that I can save it as a template. I will first delete all of the indicators. By clicking here, I can edit my chart settings. I will begin with properties. I will eliminate my value and date grid lines and the symbol watermark since it is not necessary. I can also from here adjust the value scale size and the date size at the bottom. I can also decrease or increase the width of the margin between the last interval and the hard right edge. I will decrease this to 6%. When I'm finished, I'll click OK. Next, I will configure the plot style itself. I'll configure this for candlesticks, set to open versus close, and for this exercise, I will color them gray. I will fill in the up bars and leave the down bars empty. When this is configured, I will select OK. I can zoom in by moving the scale at the bottom of the chart. Following this, I will return to Edit Chart Settings to ensure that I am using a logarithmic chart. Now I can add my indicators. By right-clicking on the chart, I can add a plot. I will begin with the moving averages, adding an exponential moving average. I will edit this, make it a 3-period exponential moving average, give it a color, and also thickness. Next, I will add the 6 exponential moving average in the same manner. First configuring it for 6 intervals, applying color and thickness. Next, I will add the 18-period exponential moving average. I will make it red. It is exponential, and I will add thickness. Now I have the 3, 6, and 18 period exponential moving averages running on the chart. Next, I will add the 3 exponential moving averages for the EMA fan. These are the 50, 100, and 200. We'll add plot, exponential moving average, and configure the 50. 50 periods with a color, and select OK. Similarly, I will add the 100 and 200 now. I have all 3 of the long-term moving averages running. They are colored blue, the 50, 100, 200, as well as the 3, 6, 18. Next, I will add the MACD indicator by clicking Add Plot, MACD. I will configure this to increase the thickness of the line, and I will change the color of the 9-period exponential moving average to red and increase the thickness for this exercise. I now have all the tools I need to perform consistent analysis using the exponential moving average systems and the swing high-low impulse pattern. I will save this chart by right-clicking and Save Chart As. I will save this as STN Daily. I will make a weekly version of the chart by going to my toolbar, selecting New, Chart, select a new STND chart similar to this, and then positioning the chart to the right. I will then change the interval to the weekly and then save this as STN-W for weekly. Now I have both a daily and weekly interval chart running at the same time. Next, I will configure my watch list. All that I need initially will be symbol and price, so I can eliminate net change and percent change, and customizing this by selecting Edit. I will remove the company name and select OK. With my symbol and price columns intact, I can now save this layout and import my PCF scripts. I will go down to the tab at the bottom, right-click, Save Layout As, and I will save this as STN Daily and Weekly. Next, I will import my scripts using the copy and paste method. Here, I have the script for the 318 system as well as the 3618 system. I will extrapolate the other systems from this logic. I will select a library, Conditions, New Formula, and copy and paste the 318 system into the window. And then I will name this STN 318. I can see that the calculation speed is medium, so the script is working. There are no errors. I will click OK. I will select New Condition Formula again, and this time I will select the 3618 system. Copy and paste. And name this STN 3618. The calculation speed is medium. The script is working. I will click OK. I will repeat this process for the 36, 618, and 350 EMA systems. When I select Library and Conditions again, I can see that I have all of my different EMA systems here listed. And I can double check them. Here's the 350 long, the 3.6 long, the 3.618, the 618. Now that I've added my scripts, I want to add my qualifiers as PCFs. The first will be the exponential moving average fan, followed by momentum up and down, trend up and down, and finally average daily volume and price. You will see why I keep these separate in just a minute. In addition to this, I will add indicators of the current price multiple of the 52-week high divided by the 52-week low, average daily volume, and I will show you how to calculate the percent risk of the current interval. I select Library, Conditions, create New Condition Formula, and I will paste my 1226 momentum up. I will name this 1226 MACD momentum up. When I look at this, you will see that my momentum is simply the 1226 greater than its signal line. I will reverse this for short. I've built this here and I can see my 1226 MACD momentum down. You can see that it's simply the 1226 less than its signal line. And here I can see the MACD trend up, where the 1226 is greater than 0, and the trend down, where the MACD is less than 0. Next, I will create a qualifier for average daily price and volume. In this case, I want my 60-day average volume to be at least 300,000 shares, and the price to be greater than 5. I will copy this and paste it into a new condition, like so, and save that. I can then see this script here, average daily volume 300K, and my price greater than 5. I've also created one for 1 million and 2 million shares, as you can see here. I will program the indicators I mentioned when I configure the watch list. But for now, this completes the PCF script implementation, and now I can create easy scans. I will begin by selecting Easy Scan from the toolbar. I will create a new Easy Scan. For this exercise, I will select all U.S. domestic equities, and I will begin to add my conditions. I will begin with the 3.6 system. Next, I will add momentum. So I want the 1226 momentum up. After this, I will add the exponential moving average fan, which is here. And finally, my last qualifier will be volume and price. In this case, I will select the average daily volume 300,000. Notice that all these are running true on the daily. I can test this by scanning, and then I will name it STN 36 long. Once I have selected that, I can place it over in my column here by selecting this button, moving, and placing it at the top. I can then delete this watch list. I only require flag symbol and price. And now I have an easy scan running for this particular system. I will repeat this again for the 3618 system. Easy scan, create new easy scan, select US common stocks, and begin to add my conditions. I will first find the 3618 condition and then add my qualifiers. Momentum, the long fan, and my price and volume qualifier. I will run a scan, and then I can test this. When it looks like the logic is accurate, I can eliminate the columns that I don't need, and I will save this. It's STN 3618. Once saved, I can move this to below this particular scan. Now I have two scans running. I will complete this configuration for the rest of the systems. Now you can see here that I've added easy scans for the 36, 3618, 318, 350, and 618 EMA systems. I can check the parameters of each scan by clicking Edit, where I can see that I have my PCF script and my qualifiers, momentum, fan, and price and volume. I keep these separate because it enables me to structure specific scans and test different parameters. Therefore, I could test scripts that are running with or without the fan, and I can change average daily volume as well as momentum. This gives me maximum flexibility. I can rescan manually by clicking this button. And if you have the premium subscription, you can stream scans. Now that I've completed my scans, I will simply add an additional watch list for flag symbols by clicking Watch Lists and Flagged Items. My flag symbols then, I will move to the left. Now I have completed my layout. A simple, easy, efficient layout for analyzing the daily and weekly intervals with a simple scanning column and flag symbol column. So I will right-click here and save my layout. On my flag symbol column, the first indicator will be the price multiple. Here you can see under my indicator, I have it as CPM. The price multiple must run on the weekly and is the quotient of the 52-week high divided by the 52-week low. I will place the CPM weekly right next to the price. Next, I will add average daily volume by clicking My Indicators and Average Daily Volume. Here I can see I just want to post my average daily volume of the last 60 days. It is a simple script. I will add this, and the column populates. Finally, I will add the percent risk for my long positions. Here you can see that this script subtracts the high of the current interval from the low, adds 6 cents, and divides by the high. This gives me the percent risk of the current interval. This is very helpful when I'm setting up my patterns for entry. Therefore, I will add this percent R to the last column, and I can configure this to reduce the size of the header. Additionally, I will increase this to 4 places for better price precision when sorting. When completed, I will save my layout. Now, each time I scan, I can right-click on a symbol and I can flag and unflag all the symbols in this list. I will do that each time I scan at the end of the interval. My flag symbols then will all appear in this watch list. From here, I could sort by price, highest to lowest, the multiple, which is a surrogate for relative strength, meaning my highest multiples will be the stocks that have made the greatest move for the year, since it is the 52-week high divided by the 52-week low. Furthermore, I could sort by average daily volume, high to low, or I could sort by percent risk. Here I can see that if these were current setups, I would have the lowest risk here and the highest here. This is all the information I need to efficiently scan and sort for setups. Let's take a look at how we can achieve effective sorting and selection. We want to focus on price action in both the reaction pattern and the trend. These will be qualified recurring continuation patterns in the direction of the breakout. Context, which also has to do with the reaction pattern and the trend, requires that our reaction patterns test long-term support or resistance. Strength of trend is also a component of context with the long-term EMA fan. For momentum, we have the MACD oscillators. And for structure, we have our trend lines. So we want to effectively combine price action, context, momentum, and structure into a simple sorting method. The goal is to achieve an immediate breakout above or below the swing high-low price level. The purpose of scanning this particular context is to capture the 18 EMA breakouts with the 3 and the 6 with momentum in the direction of the long-term trend as indicated by the EMA fan. So I will be looking to take swing high patterns off major support at the bottom of these consolidations and then shorting the sell-offs on the breakdowns below the 18. On this particular chart, you can see the interplay of the 3-6 coming over the 18 in the direction of the trend and then breaking down below the 18 as the stock corrects. We want to capture the longs in the direction of the primary trend and short the sell-offs. The reason that I scan the various systems is because of variation as the 3-6 crosses over the 18. I want to be certain that I capture all of the moves. Some will occur with 618 crossovers, some with 350, others with the 3-6 variation. In any case, in any interval, I want to make sure that my price is at least bouncing on either the 18 or the 50. So when I analyze stocks in this particular scan that I move to my flag symbol list, I want to focus on this because I have a swing high pattern that is bouncing off major support, as opposed to this particular candidate, which is not. Although I will watch this to see what evolves, I tend to focus more on breakouts that are bouncing off the long-term support. Let's take a look at some recent setups to give you an idea about how I do this. I want to be certain that I'm scanning the 3-6 so that I catch the breakdowns and breakups with the 3-6 swing high. A recent example is here in LYB. Here you can see the 3-6 swing low, followed by an immediate test of the 18 with momentum. I want to be certain that I capture these trades. Here's another example of the 3-6-18 recent trigger in Broadcom. Here I have the 3-6 and the 18 breakout, which immediately tests the 18. The extremely low risk setups. Here's a recent setup in NOW. Remember that I'm looking for price action, context, momentum, and structure with my trend lines. To apply my trend lines, I will populate my tool where I can select the trend line feature. Since I've selected Snap To, it will automatically place a trend line at my desired pivots for accuracy. Here I can see a recent swing high on the 618 system in NOW. Here I can see a constructive continuation pattern of a high inside bar reversal that is hitting both the 50 and the 18. I apply my trend structure up and down to facilitate the context that is most likely to result in an immediate breakout. Here's another recent example in NOW of a 318 swing high followed by an inside bar. Notice the inside bar is testing the 3-6-18 with momentum. This is the only time that I will trade inside bars that are bouncing on major support. Since I don't have trend line structure, I want to ensure that I will not be stopped out and I get an immediate follow through. Here's an example of a recent swing high in WWE that I do not want to analyze. You can see that the inside bar evolves nowhere near major support. Once you begin to log screen time, you will start to see the recurring pattern of the base breakout over and over again. The 3-6 will trade below the 18, consolidate. The long-term trend is dictated by the 50, 100, and 200 moving averages will remain up, at which point price will move back out over the 18 and give you a setup. Here's a recent example in Avago Technologies. Here we see a 318 and a 350 pattern combined with the MACD momentum. We also have proper trend line structure. Notice the reaction is bouncing on the 6, 18, and 50. Most important is the 1850 test. This reduces the likelihood of a stop out tremendously and increases your win rate. Here is a recent counter trend example of a sell-off in Avago Technologies using the 3-6 system going down. Notice that the reaction following the swing low tests the 18 and the 50. Also, this setup has proper trend line structure, which produces an immediate reaction in the direction of the setup. Systematically scanning for the various EMA systems and moving them to flag symbols will allow you to systematically scan and sort for the lowest risk entries with proper structure. Here's one last example of a potential base breakout in KR. Here we see a 318 swing high, followed by an immediate reaction, whereby we have excellent trend line structure and momentum. Also notice that the pattern is pulled back to the 18 exponential moving average within the larger context of the 50, 100, and 200 EMA fan. Sorting and scanning for these particular systems will give you a small watch list that you can quickly and easily monitor for low-risk setups in just a few minutes a day. Remember, consistent scanning means consistent results, and a simple layout that eliminates superfluous information and reduces stress will greatly increase your consistency. To begin, try integrating a simple scanning layout. Consider the process of analysis to action, and learn to wait for the obvious low-risk entries. Be certain to identify the low-risk entry in any scan, and sample only the highest probability setups. Do not overanalyze. Think price action, context, momentum, and structure, and focus on the setup. Probability and the trend will do the rest of the work. Remember from previous segments, the key to impulse pattern recognition is setting up the same structure and context over and over again. This makes scanning and analysis quick and routine, and the decision-making process easier. The secret to successful setup trading in multiple time and data series is consistent application. You will not see qualified setups in every scan or interval. You are paid to wait for the lowest risk, highest probability entries. Developing an efficient layout and procedure for quick scanning in just a few minutes is a massive edge over the typical trader who is overwhelmed by superfluous information and conflicting indicators. This concludes the Creating an Effective Desktop Layout segment of Stock Trading Ninja. I'm your instructor, Frank Bunn. Welcome to Stock Trading Ninja Part 12. My name is Frank Bunn, your instructor, and in this segment I want to introduce you to a concept I call pulling the trigger. It is the matrix, or the life cycle, if you will, of a trader that I use to coach my one-on-one clients. The matrix is the flow of knowledge and experience that ultimately either results in frustration and failure or lifelong profitability for the trader. Whether or not the trader knows it, he or she will have to make this journey, or not. And I know firsthand because I made it. You see, the thing is, unless the trader is able to overcome certain specific hurdles, principally dealing with the ability to manage randomness and variation, that trader will either spin out and take himself out of the game or spend years of wasted time and effort trapped in the frustration cycle. Because ultimately, most traders learn that even though a purely mechanical system is desirable, it is the development and honing of certain intuitive principles that ultimately allow the trader to make the leap to lifelong profitability. Only through intuitive mastery does the trader find the two things necessary to compete with randomness on a daily basis: flexibility and choice. So let's look at how this works. It is beyond the scope of this training to cover all aspects of the matrix, but we want to focus now on content, the mechanical, and the intuitive, as you see here. Content deals with the specific information to which traders avail themselves, in the form of quotes, charts, and tools associated with them. For the screen trader, the time and data series of the interval chart is the primary tool. The trader must master and integrate these tools so he or she can begin to see the truth in this data. This is imperative because traders ultimately trade their beliefs about the market, these beliefs being what they see in the information in front of them. Once the trader becomes comfortable with these tools, he or she naturally begins to experiment with the mechanical aspects of system development, realizing immediately that some mechanism is necessary to create a system in order to deal with all the relentless variation the trader sees in the content. These mechanisms might be patterns and their precision, specific system definitions or rule-based trading systems. They might also be specific content tools such as indicators or filters to mechanically determine trends, such as my strength of trend indicator, the exponential moving average fan. And this may relate to position sizing and even trade management. At some point, the trader must cross over and begin to introduce intuitive reasoning into the mix, because ultimately, the streaks of underperformance and loss presented by most purely mechanical systems over time are unacceptable. So the trader continues to focus on system development. When traders maintain this focus and fail to see or develop the intuitive component, they can remain in the areas of content and mechanism for months or years, resulting in the Holy Grail syndrome, which is the search for the perfect trading model, and the frustration cycle resulting from constant system development and trial and error experimentation. Given the fact that you are taking this training, you might very well be in the content and mechanical phases right now. But sooner or later, the trader begins to see the power of the intuition as a risk reducer and a trade selector, because of the amazing capacity of the human brain for pattern recognition. This intuition is developed through hours and hours of screen time and empirical data, as well as hundreds or thousands of samples and routine testing. Once there, the trader begins to see and learn the different types of risk and how he or she can exploit them. Furthermore, the trader realizes that trade management, pattern recognition, and contextual risk are also components which lend themselves to intuition. Here, the traders learn that the real secret to long-term success and lifelong profitability lies in their ability to sample low intrinsic and contextual risk setups. And they truly learn the definition of a low-risk, high-probability trade. During this time, the trader will also master the mechanics of trading, which is the physical order entry and trade placement to improve efficacy and reduce error, and finally must develop the discipline to trade the mechanical intuitive function day to day. And so the trader comes full circle, having acquired the tools for lifelong profitability, and is now able to hone new skills as technology produces more efficient content. And the matrix cycle unfolds again and again. I hope this segment has been an introspective journey for you, because given that you now understand what must happen in order to become a career profitable trader, you can see where you are in the matrix, and this awareness is powerful knowledge. Because if you know where you are, you can see where you need to go and what you must do in order to achieve your goals. I found so many of my students flipping around from one strategy to the next, one trading method to the next, without ever realizing where they were on the journey. I'm hoping that this helps you do just that. And if you're still stuck in the frustration cycle, I suggest you find a mentor who has made the journey. In the next segment, we're going to conclude the training with some exciting information, so I'll see you then. Hello, and welcome to the conclusion of Stock Trading Ninja. I'm your instructor, Frank Bunn, and in this installment, we're going to wrap things up and review the key principles, as well as look at some of my recent trades and the awesome power of this strategy. Let's begin by reviewing the training objectives we targeted in the first video. We learned all about the universal trigger, and develop the requisite pattern recognition skills to finding it successfully. Next, we learned all about the key price action patterns which evolve following the swing high-low pattern itself. And, most importantly, we learned exactly how to set up trades and control risk, including the 3 integral types of risk. After this, we looked at how to create various systems and which ones seem to work the best, and also how to backtest them properly. And the very significant segment number 9, where we learned the basics of intuitive trade selection. And with that, you now possess all the tools necessary to get to 90% winners. Because you understand the trend flow objective, which is the real secret to trend trading, regardless of what system or strategy you use. We first gauge the impulse, then wait for a reaction or contraction phase according to the market cycles. And in this case, we look for the universal trigger, the swing high or low pattern to evolve, in addition to the key price patterns, which allows us to set up a trade entry with very limited risk using a risk-based trading game, and theoretically unlimited reward. And we also know how to further reduce intrinsic and contextual risk. That's almost 2 decades of hard-won knowledge right there. So just remember, it's not just about the entry, but also the overall trend context. And here are some recent trades I've made. Note that all of the setups are from my favorite system, the 3-6-18 breakout system. Notice the price patterns. The strategy continues to work over and over again, even though I'm giving it away. Here's a long setup in liquid metal which doubled. And here's a 4R short gain in IBM during the recent market correction. And here's a massive 200% move in Genvec. Now that you know the logic, you can see the setups and the price patterns. And here's a 50% gain in Quick, a classic IB 2-bar pullback pattern. Notice the last pullback bar bouncing on the 50-period exponential moving average. That's low risk. So in conclusion, remember that technical signals produce random outcomes. The solution is to manage randomness because you can't control it. And we do this with setup and intrinsic risk management, with a risk-based game and some old-fashioned discipline. And that results in consistent profit. And so the impulse plus the patterns themselves result in price rejection. And that's what gets you 90% winning trades. During the introduction, you were challenged with what you will do with this knowledge once you possess it. And you learned that what is required is integration, which comes from a commitment to putting this knowledge to work. And now you know that you can achieve that growth, development, and massive profit through testing and making the strategy your own. And you might also remember my personal guarantee. Well, here it is. You have now acquired a specific skill. This particular skill will enable you to locate high probability trades and make a fortune trading any market that can be charted. The question is, what will you do with it? Because knowledge isn't power, as every ninja knows. Application is power. I know you can do it because the stock trading ninja is with you. I must express my sincerest gratitude for having you along on this ride, which promises to be a life-changing, profitable journey for you. I really do appreciate your willingness to step out of your comfort zone and familiar habits and push yourself in the direction of self-mastery and discipline. Because the best thing about randomness and random outcomes is that the next big winner is right around the corner. You just have to be ready. And now you can be. I thoroughly enjoy hearing from traders all over the world who have integrated these principles and started making serious trading profit. I thank you again and wish you a stress-free, wildly profitable trading career. To your success. Have a great day.